watching the latest news from financialmirror.tv. Central banks around the world cut interest rates in unison on Wednesday in a joint response to the global financial crisis, giving a boost to battered stock markets. The Fed, ECB, Bank of England, Bank of Canada and Sweden's Riksbank each cut their benchmark rates by half a percentage point. The Bank of Japan didn't participate in the move but said it supported the action. Switzerland also took part, while China's central bank lowered its key one-year lending rate by just over a quarter for the second time in 3 weeks. The rates cut decision follows a global meltdown that sent US stock indexes heading for their biggest decline since 1937, while Japan's benchmark saw its worst drop in 2 decades. Policymakers are also aiming to unfreeze credit markets after the premium on the 3-month London interbank offered rate over the Fed's main rate doubled in 2 weeks to a record high. The Fed reduced its benchmark rate to 1.5%. The ECB's main rate is now 3.75%. Canada's fell to 2.5%. The UK's rate dropped to 4.5% and Sweden's rate declined to 4.25%. G7 finance ministers and central bankers will meet in Washington on Friday to discuss the deepening financial crisis, and measures to stabilize global stock markets will be on the agenda. European shares were only slightly down by midday on Wednesday after a dramatic coordinated rate cut by the world's top central banks lifted stocks from 5-year lows. Banks retraced much of their early losses after the rate cuts, but HSBC and Banco Santander were still down by just under 2%. Banks have taken a battering over the past few days as investors shrugged off a $700 billion US bailout package and focused instead on a drying up of money markets. Interbank borrowing rates remained high after the concerted cuts on Wednesday. The worst financial crisis since the Great Depression forced Britain to announce a £500 billion rescue package for banks that included plans to inject up to £50 billion of government money into the country's biggest operators. British bank shares reacted positively, with HBOS jumping 58%, boosted by hopes that the takeover deal with Lloyds TSB would go through, and Royal Bank of Scotland rising 20%. Across Europe, Britain's FTSE 100 was flat, Germany's DAX down 1.3% and France's CAC down 0.6%. The day started dismally, with European shares tracking Asian markets, which featured Japan's Nikkei average tumbling more than 9%. Spanish Prime Minister José Luis Rodríguez Zapatero said late on Tuesday that his country will raise a guarantee for deposits in its banks to €100,000 and set up a €30 billion fund to buy assets from banks and keep credit flowing. The Bank of England will offer £200 billion in short-term lending in order to kickstart stalled money markets, and Britain is guaranteeing a further £250 billion to help banks refinance debt. The news came too late for 2 Icelandic banks that collapsed, while the British government said an online lender's deposits were guaranteed. One of Russia's leading stock exchanges suspended trading until Friday after share prices fell too sharply. Shares on Moscow's MISEX index dropped by 14% in the first half of Wednesday trading, prompting the halt. The country's other key index, the RTS exchange, has also been suspended after falls of 11%, though no time frame has been set for it to reopen. Both indexes saw record losses on Monday, while measures to boost banking system liquidity received a tepid reception. The falls in Russia and elsewhere have been blamed on panic selling by global investors, fearful of a deep worldwide recession, while Russian shares were also hit in August amid concerns about the conflict in Georgia. The dollar dropped short of 1% to 1.3706 per euro from 1.3588. The US currency fell 0.7% to 100.78 yen from 101.47. The euro increased 0.2% to 138.08 yen from 137.89 after global central banks made joint cuts in borrowing costs, reducing demand for the US currency as a haven from credit market turmoil. Sterling erased early gains against the euro in volatile trade on Wednesday, as traders digested the UK government's multi-billion-pound bank support package and another sharp fall in UK stock markets. In hectic trading, the euro was trading at 77.76 pence, almost flat on the day after hitting session lows at 77.88 pence. Oil fell by more than $4 a barrel to a 10-month low of around $86 on Wednesday, as expectation mounted the international financial crisis would have a major impact on demand for fuel. US light crude for November delivery was trading at around $86 and London Brent crude nearer to $81 a barrel. The slide was in line with weakness across financial markets. Attention is now expected to turn to oil inventory data from the US government's Energy Information Agency, as an increase in inventories could put further pressure on crude prices. Signs that members of OPEC have become uneasy about oil's sharp price drop also failed to hold up prices, following a $2 a barrel rise on Tuesday. Japan is looking to many companies and big firms to join an over-the-counter market for carbon offsets that is being launched to spur voluntary efforts to cut emissions. Japan announced at the Reuters Global Environment Summit in Tokyo that companies joining the Voluntary Emissions Trading Scheme, also known as JVETs, will be floated on a trial basis. In the trial market, a company's target limits either the total volume of energy origin carbon dioxide it emits or the amount of CO2 per unit of production in contrast to the European Union's cap-and-trade emissions scheme. Under the Kyoto Protocol, Japan is obliged to cut greenhouse gas emissions by 6% up to the year 2012 period from 1990 levels. But the electric power sector, one of the biggest potential offset buyers, has been reluctant to use any market scheme based on a particular company rather than an industry sector. Carbon offsets were traded at an average 1.250 yen, or $12 per ton, in JVET's second phase that ended in August, up 3% from that in the first phase. The Canadian Grand Prix, staged at the Circuit Gilles Villeneuve in Montreal since the late 70s, has been left off the latest Formula One calendar, while the Sports Governing Council wants to stage a race at the Disneyland Paris resort by 2010. Abu Dhabi will stage its first event in November next year, which will also be the final of the 18 races. F1 Chief Executive Bernie Ecclestone is desperate for his sport to move away from the French Magny-Cours, which is an isolated circuit in the rural centre of the country. There are alternatives to Disneyland, which is about a half-hour drive from the capital, but it is reportedly Ecclestone's preferred venue. French reports suggest that the Lagardère Group and the resort's owners, Euro Disney, have already devised plans for a temporary F1 track that will use some existing roads and require purpose-built sections. The French Racing Federation is expected to publish a shortlist of 4 potential 2010 Grand Prix venues next week. Thank you for watching FinancialMirror.tv.